Okay, good morning, everyone. Thank you for being here. We're going to kick off day 2 here. Welcome back to day 2 of the Oil and Gas Conference. Hope you're having a good conference and having good meetings, and you're able to attend some great presentations. Had a great day yesterday, and as a reminder, if you can find the complete schedule and our digital conference book on the conference website, theoilandgasconference.com. If you want any additional information about the presenting companies and their financials, please go out there and take a look. So we're going to kick off things today with conference global sponsor Drillinginfo. And with us today, I'm pleased to introduce their VP of Market Intelligence, Bernadette Johnson. With over 10 years of experience in the energy industry, Bernadette is an industry expert with extensive background providing crude, nat gas, and NGL fundamental analysis and advisory services to various players in the North American and global energy markets. As a regular commentator for and speaker to the energy industry, her specific market expertise spans financial trading, production forecast, demand forecast by sector, infrastructure analysis, midstream analysis, storage value analysis, and price forecasting. Please welcome from Drillinginfo, Bernadette.
All right, thank you so much. Thanks for the warm introduction, and thanks EnerCom for the opportunity to speak today. I'm going to get going. We've got 25 minutes. I always have a lot of slides. Move pretty quickly, so if we've got questions, we'll hold them to the end, and I'll be available outside the room to answer them one off. So let's get started. Introduction and key takeaways. So a little bit of a roadmap. What do I hope that you're going to take away from the slides? Oil market key drivers, Venezuela, right? One of the ones we get questions on quite a bit. We have some of the latest and greatest data from the IEA that came out Friday, so we're going to give you an update on that. OPEC cuts, still maintaining those cuts that really were reestablished early this year. We're going to talk about where they are relative to those quotas, how much spare capacity we also think is out there in case of a supply disruption somewhere globally. Demand is the big one. Demand and that trade/currency wars. That's really the focus of the market today and likely going forward for the next few months, if not years. The issues with demand that implies. So with trade wars, with currency wars, with the major national banks cutting interest rates, that's impactful and that's really meaningful for demand. So that is really the issue today. Why have prices dropped? Rebounded a little bit, but why are they in the 50s and low 50s? It's really primarily because of that. And then U.S. production growth. So we'll give you an update on U.S. production growth. Rigs, activity, breakevens, where do we expect production to come from? In a nutshell, we're expecting still about 1 million barrels a day of crude production growth this year over last year. So that's point to point, December compared to last December, about 1 million barrels. Last year was 2 million barrels, right? So we're not growing as fast, certainly, but we're still growing. And that's important, and it's a big part of why the market is still oversupplied and why prices are doing what they're doing. And then natural gas. We're going to shift gears and talk about natural gas, specifically demand, supply growth from the Northeast and the Permian, where we expect growth to come from going forward, and what we're seeing overall with the gas markets. I also put in some spacing information. So spacing is really the question of the day, right? And so we just recently released a comprehensive spacing data set. It's 300 attributes for 170,000 wells across the country, predominantly covering the unconventionals. And we're going to show you some key takeaways for that related to how parent wells are performing, how infill wells are performing, how those child wells are performing, and what that means going forward. All right, let's start with crude oil. Crude oil supply and demand. So this is IEA data. So if we look at this, the green line is demand, the blue line is supply, and the red bars are showing you the difference between the two. So if we focus on the red bars, one of the first things I like to point out is that peak. That peak was actually at the end of 2018 in Q4. We were oversupplied by about 2.7 million barrels. That peak is higher than the peak back in 2014 and 2015 when prices first collapsed in the first place. So I like to highlight that because I think that point is still not well understood by the market. It was 6 months ago that we were more oversupplied than when prices first collapsed in the first place. And so that's important, and that's a big piece of why prices are lower today, why we think there's more risk that we don't see higher pricing than $60 for a couple of years, and why it's taking the market some time to rebalance. Fast forward to Q2, the market was oversupplied by 450,000 barrels. Now that data point is updated as of Friday, right? So before the updated June data came out, it showed oversupplied by about 350. So that got a little worse, right? So you see all the articles this week that are saying IEA revised their demand downwards. We're growing at the slowest pace in terms of demand than we were compared to, I mean, we haven't seen this low of a rate since the financial crisis almost 10 years ago. So the demand story is dominating headlines, but that we also saw revision upwards in supply. So both of those things net, we're more oversupplied now than we were. And at the same time, demand is growing slowly. So that's an important data point to watch. So let's go some country by country information, OPEC, a little bit of an update on what's happening with global supply. So Venezuela, crude oil production, this data point that I added is July. June steadied out a bit, right? It went from 860,000 barrels. June actually popped up by 10,000 barrels to 870. The July number came in at 810. So we lost additional significant supply out of Venezuela. If we remember last year at this time, and even 18 months ago, the market was thinking there's only so much that Venezuela can lose, it's going to steady out, it's going to level out, and it's going to be fine. We're not seeing that. We don't expect to see that. We think we'll continue to lose between 30 and 40,000 barrels on average per month, and it's this excess supply it's really coming out of the market, but the rest of the market can either meet and pick up and add to the market or not, right? And so this is a part of why we're not more oversupplied than we were. If you think back to early 2017, they were producing 2.1 million barrels. So this is important. So another way to look at this is, if this supply hadn't come off, the market would still be significantly oversupplied and we'd be in a significantly worse situation, or more OPEC cuts would be necessary. I like to add a point at the end of that Venezuela slide also. That's not a supply source that we can expect to come back, right? If you track Libya, you track Nigeria, you track the wildfires that happened in Canada, those supply disruptions, while significant, were relatively short term. The Venezuela supply disruptions and continued drop is not going to go away quickly, even if there is a sustained change in leadership. So that's one we should continue to see fall down. It's not an area where we expect supply to rebound very quickly, if at all. What about Iran? So the other question we get a lot is about Iran. So this data point, again, was updated for July. I would say if you look at that number at the tail end of this chart, according to official numbers, Iran is producing less than they were last time sanctions were around, right, that previous low. But we know that number, in all likelihood, it's exaggerated, right? We know that a lot of those barrels are very likely hitting the market, going back channels, and probably landing in China, right? So if you look at where the official Chinese numbers, it looks like they're importing a lot less. But that's really not true. We don't see that reflected in global balances. So when we look at this number, we caveat that and we say, it looks like they're producing at low levels, but the global supply demand doesn't reflect that. We believe, and the market believes, that a big chunk of those Iranian barrels are very likely going through back channels and landing in China, maybe through Turkey, right, as what happened last time. So that's something to watch, certainly. But according to the data, is a little bit lower data point even than June. What about the rest of OPEC? So this table we put together to show the quotas in the first column. So these are the latest round of quotas. The July 2019 data, so that's again the freshest data that just came out. The compliance column is calculating the difference between the quota and their production. Green is good, meaning they're more than compliant with their quota numbers, meaning producing under. The red is bad, so Iraq producing over their agreed to quota. Net, it means 367,000 barrels in overcompliance, meaning they've more than cut what they agreed to with the latest round of cuts. We also calculate the sustainable capacity. So that column there, that's showing you essentially a recent peak. So we're not showing you a peak that was back in 2012, right? We're showing you a recent peak. For most of these countries, that peak was actually at the end of last year, corresponded to when the market was oversupplied by that 2.6 million barrels that I showed you at the beginning. So those peaks, why did it happen? Well, they were going into negotiations, about to start the latest round of cuts. Everybody started producing like crazy, so they were at a higher level before their cuts kicked in. So whatever they agreed to cut wouldn't be so impactful. And so that's what we saw, right? Saudi Arabia, over 12 million barrels, et cetera. We take that sustainable capacity, And we label it sustainable. I would caveat that. I would say there are definitely questions in the market as to that Saudi Arabia number. Could they sustain that level long term? Maybe, maybe not. They hit that level in November. Could they maintain that for years? Probably not. So there's a little caveat to that data. But if you think of that recent peak, in theory, if they hit it recently, they could hit it again. Compare that to where they're at today. Calculate their spare capacity. Spare capacity gets you to about 3.3 million barrels. So it seems like a lot, but again, I would caveat that and say probably chop off at least 25%, because can they really maintain that very high level we saw in November for most of these guys? Probably not. So if we cut that, market has 2.5, 2.7 million barrels a day of spare capacity. I would call that not significant, right? If you think about it, where could we lose supply? We could lose supply in Libya overnight, right? Libya is producing near 1.2 million barrels. Ever since the ouster of Gaddafi, production really oscillates between 200,000 and 1.2 million. Libya is the main reason that prices collapsed in the first place back in 2014. They showed up with 1 million barrels that nobody thought they had. But what happens in the country? There's still no central leadership. And when peace falls apart, they blow up the ports, the exports come way down, their supply comes way down to 200,000 or so. So call it 1 million barrels that could be at risk in Libya. Is it going to happen tomorrow? Probably not. Could it happen tomorrow? Definitely. So there's 1 million for Libya. Nigeria, the terror attacks. Has that been completely resolved? Probably not. So that's a risk of supply disruption. Venezuela is still losing barrels, right? So you look at that, call it 2.5 to 2.7, is that enough spare capacity given all the things we know that are happening globally that could impact supply? For today, it's enough, and it's why prices are doing what they're doing. But those things happen, right? We know a supply disruption will happen. We don't know exactly where and exactly when, but it always happens. So that's something to keep an eye on. And I would say that's not a ton of spare capacity. That's one of the reasons we look at this. We think to the future 2 or 3 years, and we say the U.S. cannot be the only grower of production globally. So we're going to get out a couple years. We think prices are going to come significantly up, right? We have a lack of investment in conventionals for the past few years. World is on track for about 1 major discovery every 5 years, and we basically missed one because we weren't investing in conventionals. So that for us is shaping up to probably some pretty significant changes in early 2020s, so maybe 2022. But for now, oversupplied, there is spare capacity, prices in the 50s make sense, the U.S. is still growing production. What about U.S. breakevens? So I said the U.S. is growing production. I mentioned that we believe U.S. grows at least 1 million barrels, point to point this year, so December this year compared to December of last year. This is the break-even information that drives our forecasts. So we break the country up into 500 different slivers of production. In this chart, I'm only showing you the areas that break even between about 25 and 100, right? So there's areas that we cover that have a break-even, a half-cycle break-even above $100. Not showing you those because we're not anticipating those will come back in the money anytime soon. What about the rest? So if this is a snapshot of what is being produced and what can be produced, depending on how prices change. The low end of the chart, the most economic areas, where do you see them? You see a lot of Permian, right? Permian's in red. You also see some Eagleford, like your DeWitt field, very economic. You even see some dark blue, which is the Williston, right? There's some areas of the Williston, not very much inventory left, but there's some areas of the Williston that have very good economics. You also see even some light green, some Anadarko. So at the top end of that stack with the best economics, you do see the sweet spots in every major play across the country. You move up the stack, I put a box around the plays that we call it on the margin, right? So that's areas that break even half cycle between $50 and $70 or so, 65. So those are the areas where we track very closely in these prices that we have today they're falling, they're coming back up, maybe they hit 60, maybe they go a little above. What are the areas where we would expect to see rigs either come down or be added based on those price fluctuations? So those are the guys that we would call on the margin. Where are those areas predominantly located? On the low end, so in the 50s, 50 to 60 range, you see a lot of Anadarko. In the 60 to 65 range, you see a lot of Eagleford and Williston, right? So those are the plays that we watch very closely that have pretty significant areas that are right on the margin that either will work or won't work depending on how high prices can recover or if they do. What about the rig count? So we track the rig count. This is one of our sanity checks. We recently acquired, as of last week, we acquired rig data. So we have the largest, most comprehensive rig data set out there. So not only do we have our GPS units that are on 90 to 95% of rigs in the country, so as real time of data as you can get, and then we also have the historical data and the typical survey method that we employ to verify things like pad drilling and those types of dynamics that are hard if you just look at GPS. So if we look at this rig count, look historically back to 2014, you can see 2,000 rigs, right? Prices collapse. We dropped to a low of 433 rigs in May of 2016. Recover, 2017 is flattish. 2018, we saw a bit of a bump, but since prices dropped again at the end of last year, you can see that rig count pretty steadily coming down. So today, we're actually running under 1,000 rigs. Even with under 1,000 rigs, we're still gonna grow 1 million barrels a day of production of crude this year versus last year. We're going to look at the gas production forecast in a second, but I would say this rig count is probably actually more impactful for the gas volumes. We're not anticipating the same levels of growth on the gas side that we've seen in previous years. So we'll show you what that looks like, but this is probably more impactful for them. Where are most of the rigs running? Still the Permian, right? Over half the rigs in the country are still running in the Permian. Pretty important area, and certainly where we expect to see a lot of production growth over the next few years. U.S. crude production forecast. So this is a volume forecast. It's crude production. The numbers at the top are showing you two deltas. First is December to December, so December 2018 versus December 2017 and so on, and then average year versus average year. So for 2019, we're anticipating a point-to-point growth of 1.1 million. So that's the million barrels that I've been quoting to you. Next year, again, about 1 million barrels, 950,000, right around 1 million barrels a day of growth. If you look at where that's likely to happen, the Permian is that light green in the middle. We're also seeing growth, though, in every major play in the country. And again, it goes back to those sweet spots. The sweet spots where you're still running rigs, where you do have decent economics, areas that can make money, even in today's price environment. You see growth in those areas. So every major play in the country growing, Permian certainly the bulk of that growth, but this is what that looks like. And then on the bottom, you see the rest of the U.S. So the rest of U.S. is more the conventional plays, it's the U.S. offshore, it's everything except for those breakouts that we provided. U.S. oil production and export. So one of the main points we like to make is that U.S. oil markets, natural gas markets, NGL markets will depend heavily on exports going forward. So we track the export markets very closely. Where are the barrels going? Where's the gas going? And what you can see in the crude picture is that the blue line is production, the green is exports. The axes are different, but they're both 5 million barrels. So what you can see is they pretty much move in lockstep, right? Nearly every incremental barrel that we produce, we have to put on the water and export. That's going to continue to be true. Demand for U.S. Crude, our refining fleet has already been running full. It's going to continue to run full. We do refine better, faster, cheaper than anywhere else in the world, especially for heavy barrels. But we've already pushed out the barrels that we can push out from imports, right? We've pushed out the mid-range barrels, we've pushed out the light barrels, and pushed in our own domestic barrels. From here on out, the U.S. is going to continue to bring in the heavies that they still bring in. We're going to send out the light barrels, and it's based on refining economics, the value of those refined products, and what our refineries should be taking and where the money is. So that's something to watch. It means U.S. unconventionals produce light crude. Those same production forecasts I just showed you, we break that out by quality. Quality is key here. Unconventionals produce lighter crude. Our refineries want heavier crude. So this dynamic is going to have to continue. It also means things like trade wars. Where can we push these barrels in the international market becomes much more important going forward, especially as there's more of these barrels. So things like the Chinese tariffs and China not taking really U.S. barrels anymore of crude, that's important, and it becomes more important going forward. Here's that U.S. exports by destination. So I mentioned China not taking any more barrels after the start of the trade war. You can see that in that darker blue in the middle. Other countries, so who else has had to pick up the slack? Because we continue to hit export records. Who else is picking up the slack? It's the rest of the world, right? So kind of a hodgepodge. But you also see Korea, a little bit in the UK, India, Taiwan, picking up a little bit of the slack because we can't send those barrels to China. Why does that matter? The efficient place to send them was China. That's what we were doing before the market was impacted by the trade wars, right? So that means if we're going to send it somewhere else other than China, we're going to have to discount it because China's really where it should be going. So if you're going to send it to a less efficient or less optimal destination, it means you need to discount the crude to land it and push out what they would rather take. So that's important. Realized prices, how much we can export and what price we get for those barrels is heavily impacted by these trade wars. All right, I'm going to skip through some of these in the interest of time because I really want us to talk about spacing and I want to cover natural gas a little bit. This is simply a map of the export pipes for crude coming out of the Permian. This is showing you a stack of that pipeline capacity compared to the line, which is production. So we're looking at these pipes. We're looking at EPIC, Gray Oak, Cactus 2, Permian Express 4. Mid-year, couple months, we should have pretty significant capacity to get you out of the Permian. Some of these pipes reach back as far as Delaware. Some of them are more Midland pipes, but you do generally have coverage. So we're expecting some recovery in the Midland price, some excess takeaway capacity on the crude side from the Permian coming later this year and pretty quickly. DUC count. Production's still growing. Many of you probably saw that article from, I think it's Kairos, I can't say the name, saying the completions aren't being reported, the operators aren't reporting them, there really are no DUCs. So that analysis was fundamentally flawed. For one thing, they weren't looking at the railroad data, the W-2 form. So if you're not looking at the form from the folks that actually regulate completions, your data is going to be flawed. And that's what we see. When you normalize for that, when you normalize for the normal lags, when some of these forms get reported on a lag, right? They don't get reported tomorrow if you complete today. Once you normalize for all of that, which we do, you can see the DUCs. How many are out there? These are bad DUCs. These are the DUCs that are out there longer than 6 months, meaning drilled more than 6 months ago, haven't been completed yet. Why? Waiting on something, a higher price, a pipeline. In the Permian, it's primarily pipelines, right? They're waiting on infrastructure. There's over 1,000 DUCs hanging out in the Permian waiting for infrastructure. So that's a number to watch. It's also a reason why we're going to continue to grow production and why we can continue even though the rig count is under 1,000. Global supply demand. So if you look at this, the green, so look at the green bars because that's the difference between global supply and demand for crude. Under the bar means we're undersupplied. Over the bar means we're oversupplied. The green bars are showing you the supply-demand balance at the forward curve. So it looks like we would be set up at the current forward curve to be undersupplied as soon as 2021. On the flip side of that, you have the dark blue. That's the supply-demand imbalance if prices were $70 a barrel for WTI and then higher for Brent. So what does that show? It means oversupplied, continued oversupply, and significant oversupply out through 2024 time horizon. So what does that mean? It means the answer is probably somewhere in the middle. That the forward curve is too low. We're going to see some rebound in prices. Are we going to see $70? Probably not. It's going to be tough. Given U.S. production growth, what's expected globally from the IEA, from other nations' production growth. I would caveat this, though, and say at the end of 2023, 2024, that's when we look at the balances and we start to see some trouble. And again, it's because of the lack of investment in conventionals, the fact that we are not on pace to hit our every 5-year discovery because we missed an investment cycle because prices were too low. And global crude markets, it's a 100 million barrel a day market, right? Natural decline's about 5%. We have to replace about 5 million barrels a year. 5 million barrels a day per year. That's important, right? And the US alone cannot meet that need. So we look out to the end of this curve and we say, very likely higher pricing. We need to see those price signals that encourage the majors to get back out there and invest. We're not there yet and we haven't seen it yet, but it's something to watch. All right, spacing. So this is a southern Delaware Wolfcamp parent normalized well. That's how you decode the top title. Now, I don't like words on slides. I left these on here so that when you're looking at this later, you can understand exactly how we did this and what we're looking at. The important number to note is the third down in that table, the 1.3 million barrel EUR in BOE. Now, the black line is essentially that normalized type curve. Southern Delaware, Wolfcamp formation well, 1.3 million barrels a day of crude EUR. That's significant. This is for a parent well. Fast forward to a child well. Look at that same row, it's about 1.15, right? So still significant production even coming out of child wells. But then you look at the infill wells and you get significant degradation. That's where you get the 800,000. So a dramatic cut from the parent, dramatic cut from the child. So this is important. So when we talk about spacing, we have geology and geophysics software Transform, right? So when we look at this, we have a fleet of technicians, geologists, reservoir engineers that are constructing spacing. If you're going to calculate spacing, you can't just take the difference between the midpoint of the perforated intervals. That's not really your spacing, right? Because wells aren't exactly parallel. Sometimes they're like this, sometimes they're like this, and it matters. The difference really matters depending on where that well is placed and how well it's placed. So this data set allows you to do that. It allows you to see how are those parent wells performing? How are the child wells performing? What about the infill wells? What is the time component? So how long can you wait before you really see that degradation? How far apart are they? How well are they hitting the landing zones? Which landing zone, right? This chart looks different depending on which landing zone you're in and which play you're in. So all of these things matter. If we look at a little bit more scoop spacing trends, you look at this, the first chart on the bottom left, that's well productivity over time broken out by year. The bottom line is 2018. So it certainly looks like the wells are performing worse over time. But you look at that, the chart right next to it doesn't really explain it because the average spacing, pretty much on track across the years, right? But then you look at the top, it's about binning. You're seeing more wells being downspaced in the sweet spots. You're also seeing more wells on the bottom, on the fringe areas, de-risking. You're not seeing as many in the middle. So if you've got more that are infill wells, you've got more that are test wells, the net result is a lower type curve, even though the average spacing would tell you it's been pretty consistent. So these are the types of things that really matter. Where you are, who you are, which formation you're targeting really matters. Well, one last point about spacing, this bottom chart on the left, some of the things that we can tell because we have the full engineering data set is that when you downspace too far, and you use too much proppant, that's when you really run into problems, right? So that orange line is proppant per foot. The green is showing you the first 6-month oil production. You can see there's kind of this optimal level depending on how much you downspace and how much proppant you use. So you don't want to use too much proppant if you downspace too much. You open up too much of the reservoir, that communication increases, and your wells are stealing from each other, right? So that's important. So how you engineer, how you complete these wells, how much proppant you use, the type of proppant you use, all of this really matters. And so these are the types of things that we look at with that data set. You can compare operators. For instance, we see Oxy actually outperforming Anadarko, even though Oxy's got more conservative spacing and less proppant because of this, right? You can also see things like Conoco in the Eagle Ford, their child wells are actually outperforming their parent wells. Why? When you dig into the engineering details, you can really start to see why. So this is the things that we're looking at. Spacing is probably the most important thing going forward. What are these wells actually going to look like? How much production volume is actually going to be out there? How high do prices actually have to be to cover that? All of that is really, really dependent on spacing, and this is the way we look at it. All right, I'm over on time, so I'm going to do natural gas in about 2 minutes, and then we can convene outside if anyone has questions. All right, Henry Hub, what's our price forecast? The green is our price forecast. The blue is the forward curve as of the end of June. The forward curve obviously much lower today. Prices have collapsed. I looked at gas today. I think it's $2.14. What do we expect for pricing? Really $2.60 to $2.75. Much above that, we're swimming in gas, way too much gas. Below that, not enough gas to meet what we see as our demand needs, including LNG exports, Mexican exports, growth in power markets, growth in industrial, and growth in residential commercial. So we're breaking those out by segment. We think that that's the right answer for pricing, $2.60 to $2.75. This year, we've got too much supply. We've filled storage pretty quickly, and really it's simply that. We have too much supply. But the gas markets reset every fall, and that will happen this year, and we'll recover pricing, and we'll see what happens going forward. This is our 5-year natural gas outlook. You can see the colored stack represents the different demand sectors and where we expect that growth to come from. The most important is that red LNG, right? These markets, just like crude and NGL markets, will be heavily dependent on the strength of U.S. exports. How much LNG can we send out? Where do we send it? What does that seasonal trend look like? Will largely dictate how much can the U.S. grow production. So tracking this is pretty important. This is our forecast for natural gas. Only about 6.4 BCF a day of growth we're expecting between average 2020 and 2024. So a slower pace than the nearly 15 BCF a day of growth we saw between 15 and 19. And so again, that's coming down to lower rig count, less demand growth. A lot of the demand that's grown already to date has been structural, right? Building facilities. That demand has been in the works for 10 years, ever since prices collapsed, and a lot of that's in place. So now looking forward, a lot of that growth is going to be slower and steadier outside of LNG. And LNG, we're still really putting a ceiling on what we think that will be to about 10 BCF a day a couple years out. All right. Skip through these. We track infrastructure for natural gas just like we track infrastructure for crude. All these pipes that are getting done or not getting done, I think the big story in natural gas is that P2K, Blue Bonnet, Pecos Trail, those pipes were originally slated to come on starting next year, right? That's the green on the top at the very end. Those pipes are either not happening or have gone radio silent because they haven't found shippers. So where it looked for a period of time where we were solving the Permian gas takeaway issues, we're not anymore. 3 of those pipes got pushed out. It really seems like if you're not Kinder Morgan, you really can't get a pipe done right now. Producers are hesitant to sign up. The smaller guys who maybe they're private equity backed and they thought they'd have IPO'd or they would have sold by now, haven't, and they've turned into development companies. If you're in that situation, do you want to sign up for 20 years of capacity, put that on your balance sheet? Probably not. So there's challenges right now getting shippers to subscribe to these pipes. We haven't solved the gas problem. We don't have enough takeaway today. There will be a little period in 2021 where we've got a little room, and then very quickly that goes away again. So we're not expecting real relief until 2022. So sustained lower pricing for longer in Permian. All right, this is an update on the LNG liquefaction terminals. We're going to have more than 10 BCF a day of capacity in early 2020. We're thinking that's the level, and past that, we're probably going to have some spare capacity, so something to watch out for. But past that, there's a lot that are proposed, a lot that haven't had it reached FID yet, a lot that could happen. So keep a close eye on those. All right, that's it. That's all I've got for you. Thanks for your time.